Hi, I'm Dean Barber, founder and CEO of Barber Financial Group. I'm excited to share with you the monthly economic update. Today, we're going to cover what's going on with interest rates. We're going to talk about the historical move in treasuries, the yield spread between the 3-month and the 10-year treasury. We're going to talk about what's going on in the stock market, why I think it's happening, and a little touch on precious metals. So this is for the month of July, but I'm going to talk a little bit about what's going on for this first week in August as well. Obviously, July, pretty benign month, wasn't a lot that went on. Markets were relatively flat, maybe up 1% or a little bit better across the board. The month of August has not started out so great. We had the big 700-point drop on Monday, another 300-point rebound on Tuesday. At one point here on Wednesday, the markets were down about 500 points. As I'm recording, they're down about 200 points. So the volatility that we were experiencing in the latter part of last year seems to have creeped back into the market. The question is really why and what's going on. Just today, we had central banks across the globe cut rates. They followed our Federal Reserve and our central bank. So 3 other countries cut their interest rates. The bonds across the globe really tanked across the board. And when I say the bonds tanked, what I mean is the yields fell. At one point today, the 10-year Treasury yield was below 1.6% for the first time almost ever. So we're seeing really historically low yields. We're now seeing for the first time in history the German 30-year Bund at negative rates. And so what was just over $10 trillion in assets held at different governments around the country at negative interest rates is now much higher because the 10-year, the 30-year, Japan and Italy, seeing those negative rates along with Germany. So there was talk actually today on CNBC and a few weeks ago when I went out to MIT Sloan School of Management for a 3-day executive course, one of the economic professors there was talking about the fact that he wouldn't be surprised to see the Federal Reserve institute a negative interest rate policy here in the United States. And I know that doesn't make any sense to you, it doesn't make any sense to me, but it's a way to try to stimulate the economy or to keep this economic expansion that we have going. And that's why we've heard President Trump speaking so loudly about Jerome Powell, wanting him to reduce rates faster and more aggressively. I want to start today with what we are seeing in the Treasury markets. And so I showed you this chart last month, and the chart here is the 3-month Treasury in the orange line here and the yield on the 10-year Treasury in the blue line. And so as this chart was put together, the 10-year Treasury was at 1.73, while the 3-month was at 2.05. And I believe as we're speaking here right now, the 3-month is about 2.1, and the 10-year is down to 1.65 right now. So we're seeing spreads widen. And remember, I told you this here over the last 2 or 3 months that every single time since 1955 that the 3-month Treasury yields higher than the 10-year Treasury, that's led to an economic recession within the next 15 months. And so at any point in time within that 15-month period, there's no specific date that we're looking for or calling for a recession. Now, a lot of people out there are saying mild recession, first quarter of next year, second quarter of next year, somewhere in those ranges. And the Treasury yields are really telling us that they're anticipating that there is a recession coming. So question is, what do we do? How do we make sure that we protect? And I will tell you that just yesterday, our short-term indicator went to a negative position, and the long-term indicator has fallen precipitously in the last 6 or 7 business days. I don't think we're going to see that long-term indicator hit that negative territory. Quarterly trend indicator is still positive for U.S., but negative for international. So we'll keep you apprised if those things change. And of course, we do have some tactical models that follow those indicators. So many of those tactical models have moved some of the money out of the market. And the asset allocation models are built to kind of go through the market cycles with the asset allocations the way that they were. So no changes in those particular models. Let's take a look at this next chart here. And the next chart very simply is the same one below, but this is going again year to date. But again, the yield spreads between the 10-year and the 3-month, and we're seeing some pretty big numbers here, 32 basis points difference between the 10-year and the 3-month Treasury. So again, this is just showing more pressure on that long-term treasury. And we actually saw 30-year treasuries hit near historic lows just today. If we think about what that's going on in the market has kind of tended to ignore that so far this year. If you take a look at this chart, we've had a couple of little bumps here. We had the month of May that wasn't so good. June and July kind of brought that back, but now August is bringing us back, and many people are saying we'll be back to where we were in May. But when I show you this next chart, I think we might see that there's a possibility that the markets go back to where they were last December. So on this chart, one of the most important pieces here is the ISM PMI. This is our manufacturing index, and this thing has been trending downward for the last several months. And if we take a look at that trend downward, it's actually been going on now for a year. So this is the last 12-month look at the PMI, negative 16.45% or 48% there. At the same time that we've had the stock market basically since December 24th lows, really doing exactly the opposite. And when we talked about this last month, I said, look, there's one of two things has to happen. You can't have these indexes going down and the stock market just continue to go up. It doesn't make sense. Fundamentally, it makes no sense. And I've been saying that the fundamentals that should drive the market and ultimately will drive the market long term have not been driving the market. It's been news. It's been the promise of interest rate cuts or the hype of a potential interest rate cuts. It's been the promise of a deal done with China on the trade negotiations. And then when we don't get the trade negotiations and when we don't get the interest rate cuts that we want, the markets throw a fit. And that's what we're seeing happening here during these first few days in August. What that tells me and should tell you is that the markets are frothy and that there's not a lot of juice behind what can drive this market much higher. So we expect the volatility to continue. We do expect it will wind up in a positive range this year. Of course, there's always the unforeseen things, but we do expect a little bit more volatility to kind of creep back into the market here during the third quarter. So we'll keep an eye on that and keep you abreast of what's going on there. The most important thing that you can do is to keep in touch with your financial planner here. Let's review your financial plan. Let's make sure that the allocations that you have are right. Let's do some stress testing to your portfolio so that you can see the potential drawdown in the event that we do turn to a bear market and the economy does go to recession. And make sure that your plan can actually handle that and you can continue to stay retired or get to retirement on the dates that you wanted to. And really, that's the critical thing. We have to keep a longer term view. We can't let the day-to-day noise that's out there in the 24-hour in-your-face media drive our investment decisions. We've got to make those investment decisions based on fundamentals. And even though sometimes those fundamentals get ignored by the market, as I said a minute ago, the fundamentals will always come back and drive the market eventually. So where has the money been going this year? Well, precious metals have received a lot of money. If you look at gold here, gold's up 12.72% this year, and most of that has come just in the last couple of months on the heels of the interest rate cut that disappointed, and then on the heels of the escalation in the trade war with China. You do have copper falling, silver all over the place this year, but we've got money flowing now into those what we call safe haven assets of gold and other precious metals. So again, that's just another sign that people are getting a little bit nervous, they're getting a little bit worried. The volatility index spiked significantly, going from around a 13 to about a 22. So that's a pretty significant rise in the volatility index, which is simply is a signal that's telling us that we should expect more volatility here in the short term. Keep us apprised of how you're feeling, what you're thinking. Your emotions are really important here. We want to try to do everything we can to help you understand exactly what we're doing, why we're making the decisions we're making, and how it fits into your overall retirement plan. So with that, I want to wish you a wonderful day. Thanks for taking time to visit with me here on the monthly economic update, and I will talk to you next month.